What's up, guys? It's Sam here, and today is Friday the 22nd, 11:15 at night, and I wanted to go over my portfolio for this week and my trades with Robinhood. But before I do that, I wanted to briefly give you some context. Ever since I learned about options and they're just intriguing nature back in I think it was my senior year of undergrad, I was just fascinated by options, and then I learned tremendously more about them in grad school, and again learning or going through the CFA program and that material I learned a tremendous amount more. I'm trying to get this camera to stabilize and so at least it looks level. How about them shits? Okay, so with that being said, if you don't have any type of understanding of what options are, I drew you a graph because I'm an awesome artist. Thumbs up for that awesome artistness inside of me. So if you have any understanding of what options are, this is something you're going to see in the textbooks. Is something like this. This is a call option, and this is the payoff. What a payoff would look like on a call option. And this is what a payoff would look like on a put option if you follow the textbooks. There's two basic kinds of options. You have a call option and a put option, and then you can buy or sell either one of those. So there's basically four different payoffs you can get. I mean, there's other types of exotic options, but I'm not even going to slightly get into those right now. And so this is the payoff if you were to buy or long, if you had a long position in a call. And you see this line here up above, and then it comes down. The inverse of that is if you were to sell it. And the same thing over here. This, right? That is if you were to purchase a put option, and this is if you were to sell a put option, right? Because if I were to sell you a call and you were to purchase that, your gains would be my losses. Now, the middle bar here, that represents the premium paid. So right here, right on this call option, for example, you start making money right here, right? Or it starts to go in the right direction right there. The stock price is going up. You bought a call. Now it has to go up for a period of time or a certain amount before you start making money. And that's because of the premium you paid for the option. Similarly, over here, if you were to purchase a put, right? It started with, whoa, man. Excuse me, thumbs up for that burp, by the way, that was pretty good. If you were to purchase a put and the price is going down, you don't start making money until it crosses your break-even point. So that is what I talk about when I talk about the break-even point. Now, let's get into my returns for this week. So I decided to actually bring in a proxy, a benchmark for this, and I will continue tracking this for the remainder of 2019, so you get to see my results and if I'm able to actually beat the return on the proxy. And if you, depending on how deep you are into finance and portfolio theory and just that whole arena, you would understand the asymmetry of returns for options versus the nature of them for like a ETF or index or stock returns. And what that means is that there's just an asymmetry around the returns. Say I picked the S&P 500 as a proxy represented by SPY, which is the ETF of the S&P 500. And with stock returns, you have a near normal distribution of returns with actually fatter tails. So if you were to say a normal distribution, right, where you have, one standard deviation represents 67%, blah, 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 2 standard deviations is this, 3 standard deviations is this much. The tails are actually fatter, meaning that the anomaly, those 3+ distribution moments actually happen more frequently than if you were to make an assumption that they were normal distributions. And with options, it is completely different. So it's not a perfect proxy, but that's what a lot of people use as a benchmark here in the United States, representative of the market as a return to compare it to. So that's what we're doing right here. Now, I started on March 10th with $1,444.85 in my portfolio for Robinhood. By the way, Robinhood is a completely free trading platform. I'm not just trying to push them or anything. It's literally the platform I use. I've used a bunch of different trading platforms like E-Trade and Charles Schwab and Thinkorswim and probably a few other ones. But this is free. It's absolutely free. It's amazing. So there's a link in the description if you want to try it out for yourself. It's absolutely free. You get a free stock if you use the link in the description. I also get a free stock. It's probably in the neighborhood of $3 to $7 or something. But there's a 1 in 150 chance of getting an Apple or Berkshire Hathaway or something like that. So now, the return on the SPY, the S&P 500, as of the 10th, right? So that was like a weekend. So whatever it closed at on Friday, up until the 16th, which is week 1, for what I've been tracking, was 103. So it's 1%, just over 1% return in a 1-week period. I had a 3.76% return in 1 week. Before you go down there and leave nasty comments saying it's fucking 1 week, I haven't got to the point yet, so relax. Now, today's 3/22/2019, and the return from the S&P 500, it started at 278.44 on the 10th, and it finished today with 279.25. And I am just pulling that from I'm just pulling that from Google and what they finished with as of today. So they the return over the last 2 weeks on the S&P 500 is about 1/3%, 0.29%. From that time period. Now, what I have returned over this time period is -9.2%, so 3 times worse. Negative 0.92%. But I wanted to cover something here before I get into some of these positions for the options. I contributed $3,287 to my portfolio in terms of the total amount of money in it, and that's at different times. So the return here has been adjusted for the amount of money that I've contributed to it. On 3/10/2019, I had $1,444.85 in it. I contributed $800 on the 13th, so that was factored into that first week return, and then the $1,000 that I contributed on 3/20 was deducted for purposes of return calculation of the 0.92%, the negative 0.92%. But there's a difference between your portfolio value and the cash on hand. So I contributed $3,300 almost to this portfolio. The cash on hand is over $4,000, and that's because I write or I sell options. I'm not in the net purchaser of options. I'm always selling options, at least at this current moment in time, and that's how I've always been. I've just been a net seller of options. So currently, the positions that were opened up last week closed profitably. But why am I at a why am I negative 1% return? So let's get into that. Let me pull up the history right here. So I had, let's take a look here. I'm just trying to distinguish what this was here. So I opened up a put credit spread for $92. That means I received $92, and that expired worthless. So I got $92. I rolled. That was on the 18th. On the 19th, I rolled a Tesla credit spread from that was going to expire on the 22nd to the 29th. So that position is in the water. That's the one underwater. That's the one I actually wanted to talk to about. And that one I received a $47 credit on. And lastly, there was a Tesla put credit spread for $47. So both of these are actually $47 that were done at just different expiration prices. And that was for $47. So the one that was for $47 and the one that was $92 both expired completely worthless, which means that somebody paid me $92 for insurance and the insurance went and Iris just got to keep the premium of $92. Same thing with the $47. That was a put credit spread for like $250 to $240 roughly. That means it's a put credit spread, so it's under the market, right? The market's above $250. I sold the $250 put with the expiration date of $322, and I purchased the $340, just roughly. There might have been different expiration price, just so you get an idea of what a put credit spread is. And then I purchased the $240 expiring for $322, and the one that's closer to the money is always going to be more expensive. So I sold the more expensive one. I purchased the cheaper one. I collected the delta on that, which was $92. Same thing for the 47. Same thing for the $47. Now, with the other 47 that I said what I rolled, I had a position that I opened for a credit. It was another put credit spread for $275 to like $265. I sold the 275s and I purchased the 265 for $322. And that means the maximum loss I could get on there would be $1,000 minus the premium paid or collected. I collected $288 on that. It was going against me, meaning I was losing money on that. And so on the 19th, I rolled that to the 29th, which is next Friday. And I did that by also collecting a premium. So I received $47 to do that. So now it changes the break even from 2.88 to 3.35. So now, and I also dropped the expiration price. So I went down from $275 to $272.50, but then there's $3.35 collected total in this series, right? So it drops down my break even to $269.15, but it goes down to $262.50, right? Because there's $1,000 between those two. So to look at this, right? So this position went against me, right? And I'm losing money on this position currently. But people have this perception that options are, and I'll track I'll tell you if I'm losing money. I don't care. Like, this is an experiment to learn from it. So people have it seems, in my point of view, a skewed perception of the risk when it comes to options. So with this, it's one expiring next Friday that I rolled for that premium. So the most I can lose on that position, right? Because I took both sides, essentially. I just left a spread in the middle. That's what I sold. And the most I could lose would be the difference in exercise prices, right? So 272.50 minus 262.50. So that gives me $10. And I just wrote it down here. If you can see this. So right in here, 272.50 minus the exercise price that I purchased, right? Because this one I sold, this one I purchased. So this minus this equals 10. So that's times 100 shares. So the most I could lose is $1,000, but I also have to factor in the premium collected, which would be $3.35. So if you take the delta of that, that's $6.65. So I apologize for not clarifying this in the beginning. I will go back and forth between the dollar amount and the value of the position, and I apologize for not clarifying that at the beginning. Everything is times 100, right? Because a option is based on 100 shares of the underlying. The underlying here being Tesla. So if it's 10 cents, that's the same thing as $10. If it's 92 cents, that's the same thing as $92 because the option price is 92 cents, but it's times 100 shares, so it's actually $92. So I go back and forth between the two of those, and that's why I'll be shifting the decimal point over here. So I said 272 minus 262.50, right? 272.50 minus 62.50, 262.50 is $10 minus the premium collected, which is $3.35. And what that premium is made up of is the $2.88, right, that I first collected to open the position, and the 47 cents or $47. So essentially I collected $335. So if you take 1,000 minus the 335, the total amount that I could lose on this position, if it just stays below the 262.50, would be $665. Like obviously nobody wants to lose that money, but you can also do a few different things. So you generally probably can't roll it for money all the time without widening the expiration price. But so what I did was I rolled it from this week to next week, right? At the same time, I shifted the expiration price down, and I collected money. I don't personally like to roll positions if I'm losing money and I have to pay money because I'm adding more risk, right? So if I could lose $250 and then I pay $50 to roll it, now I can lose $300. So I prefer to take money off the table in this situation, especially if you're in a losing position. I don't necessarily want to add money to that position. But now, if you look at it, the price of this option is $538. So what I could do, and I have it up right here, the 272 and the 265s for today. This is actually my position, right? And where's the expiration? Right there, 3/29. So I could actually purchase this position for $538. So what that means is, if I bought this position, which would just be, right? So I'm short 272.50 and I'm long 262.50. So if I bought this position, I would be doing the inverse of the positions I held to close it out. What that means, like if you were short a stock, you just buy the stock to close the position. Same thing with the options, right? Essentially, I mean, maybe a little bit different with that, with stock, but if I'm short the 272, in order to close that position, I purchase it. Now, if I'm long the 262.50, in order to close that, I sell it. So to do exactly that is $538 that I would pay. But I collected $335. So 538 minus the 335, I would actually only be short $203. So in essence, you never really have to get the maximum loss, because I think about this. When would you ever have to get the maximum loss? Yeah, I mean, I don't see how you're ever going to hit your maximum loss on this, because, right, so the $665, you're never really going to hit that, because even if you can't roll it for taking in money to take money off the table, right? If you can't roll it for a credit, in options, credit means you take money, debit means you pay money. So if I say credit or debit, that just means if it's a debit, I'm purchasing something. If it's a credit, I'm getting something or selling something. And if I say write, so writing, selling, shorting are kind of all synonymous. So I do change those back and forth. If you're writing an option, that's essentially selling an option or shorting an option. So some of those things that I will say, but they're all mean the same thing. Same with purchasing or long something. If I'm long something, that means I've purchased it. I probably should have articulated some of this from the beginning. But you can Google some of this stuff if you're interested. So if you think about it, you never really are going to lose the maximum on this. If you're paying attention, because even as you get closer to expiration, right, you can always close the position early. So you don't have to do this. You know what I mean? Like you can always close the position early, and then you don't have to even worry about this whatsoever. And doing that, you actually pay less. You have a maximum loss that's always less than you have a actualized loss, like an effective loss that's always going to be less than what is the maximum loss here. Hopefully that makes sense, because right, you're only going to lose $665